Hi, everybody. Sorry about that. Just trying to get all of our IT in order. I guess it's sort of late morning, so I'll say good morning, everyone. Welcome to the 18th Annual Pershing Square Challenge. I'm really energized and excited. I hope you're all feeling the same way. My name is Benjamin Isaac. Some of you may know me. I'm an adjunct professor for applied security analysis alongside my colleague, Lauren Harmon, who's just over there in the houndstooth blazer, I guess it would be. This event is a culmination of a whole semester of ASA. The mission of this course is to give students a relevant professional experience where they prepare a strong, fully researched investment pitch while also developing their philanthropic thinking and deciding what charities they might want to benefit from their hard work. Well, this year, that professional experience was particularly realistic. The ebb and flow of the trade war has led to changing fact patterns and stock prices for the students just as much as it has for the professionals in the audience. So firstly, to the students, thank you. I am always grateful to my classes, but I'm especially grateful to you this year for your energy, effort, and positive attitudes during a challenging environment. I love this industry and am privileged to work in it. And I can say with confidence, if you can thrive under these conditions, investing might be the career path for you. Remember that during periods of high uncertainty, there's always some kind of opportunity being created. You just need to stay calm, do strong research, and focus on the facts. Having the courage of your convictions under pressure while not holding on to falsified opinions is a vital skill. I'm confident that you will look back at this moment in your professional life as an extraordinary ringside seat to the most challenging and exciting parts of investing. The course has 24 teams this year, and there's been a ton of good work, by the finalists certainly, but by many other teams as well. Lauren and I hope you feel proud of your good work. We are certainly proud of you. We hope it can be a professional calling card for you and a launch pad to a very fulfilling career in the most intellectually exciting business in the world. Please just don't forget that with the benefits of the career also come the responsibilities of helping the world appropriately as well. Lauren and I have some acknowledgements we should cover. Thanks to Meredith, Julia, and the rest of the Halburn Center supporters. We simply couldn't do it without you. You make it happen. Thanks to our TAs, Alice and Ravi, for helping make this class possible. Both Lauren and I have young children at home, so thank you to our spouses for helping us be the best educators that we can be. Thanks to the judges and team mentors for taking time out of their busy lives to help elevate this event. And thanks, as always, to Bill, Ryan, Anthony, and everyone at Pershing Square that helps make this event into the institution that it has become. It is an honor to do our small part in keeping that tradition thriving. With that said, just a few logistical notes. Each team will have 10 minutes to pitch, followed by 20 minutes of Q&A from the judges. Afterwards, the judges will deliberate to pick a winner. For everyone else, lunch will be available. Will be available in the lounge space by the stairs, right? While we wait for the judge's decision. We are excited to see the finalists present after so much hard work and preparation. Best of luck to all, and I will now pass it over to Bill.
This is, I guess, the culmination of the semester, but kind of remarkable that this is the 18th year of this program. And what I can say, I see this each year, is one, the quality of the presentations and the students has gone up a lot. So I don't know whether this class can take credit for advancing Columbia Business School, but perhaps we should just take credit. But the investment business is a great business. It's a lot of fun. It's economically rewarding. I think it could be one of the most intellectually interesting careers you could take because you study not just, business itself is interesting and you get to learn, lots of different businesses. But again, thanks to Ben and Lauren for sharing their time. Obviously, without their help, this wouldn't happen at all. We have the easy part. We get to, it's a little challenging. We got to pick the best few with the winners, which is a lot of fun. But with that, let me introduce judges. Maybe they should introduce themselves. So maybe talk a little bit about what you do.
Sure.
And a little bit
stand up.
background.
I'll stand up. Hi, good morning, everyone. Very honored to be here again. Thank you for inviting me back. So I'm the CIO and founder of 221B Capital. I have about 30 years in the capital markets, so been doing this for a while. Started out as a research analyst at Morgan Stanley and then segued into the buy side, working for folks like Chris Hahn of the Children's Fund. Have sort of a reputation, I guess, for short selling. but also looking for high quality long ideas as well. So we run long short with sort of low net, but we focus on technology, renewable energy, and industrial companies.
Great.
Yes. My name is Dennis Jean-Jacques. I'm the founder and CIO of Ocean Park Investments. I've been in the industry for over 20 years. Started my career in the early 1990s as an analyst at Fidelity, worked with people like Peter Lynch and Jeff Vinnick, and then went to Harvard Business School. At the Harvard Business School, I was recruited by the late Michael Price, worked with him, basically doing deep dive on investing, activism, and things of that sort. So that was the first 10 years of my career. The next 10 years, I basically was running long short risk mitigation platforms, what you guys would call pawn shops now. And I started Ocean Park in 2016, basically combining those two different decades under one roof and one strategy. We focus on industrial-related companies of hard assets and cash flows, and very appreciative to Bill. My claim to fame is actually knowing my good friend Whitney Tilson, being able to introduce me to Bill Ackman about 20 years ago when he was running Gotham. So I'm very much appreciative to be here with you guys.
Thank you very much. Ali.
Hi everyone, I'm Ali Nambar, and I've been affiliated with Pershing Square for almost 2 decades. I started out initially as an investment analyst, so I worked on the investment team for about 12 years. Then I transitioned over to the Pershing Square Advisory Board. Today I run my own private investment fund where I manage exclusively my own capital, and I'm also a Columbia undergrad, and I'm very happy to be here.
What about music?
I like to play music. I used to, in my 20s, I was a musician. I had a artist development deal with a major label, and then I went to Wharton, transitioned over to investing, which is now my top love, but I still love music.
Manny.
Hi everyone, I'm Manning. I've been on the investment team at Pershing Square for a little over 3.5 years now. Before Pershing, I worked in private equity, and then prior to that, started out in investment banking. So looking forward to the vision.
Anthony.
Massaro. I've been at Pershing for 12 years and also on the investment team, and I think this is also my 12th Pershing Square Challenge in Columbia, so happy to be back. It's always a great time, and looking forward to some great ideas today.
I am Pat Sosnick. I graduated Columbia Business School in '94, so a little over 30 years ago, and I took the predecessor course to this, security analysis with Jim Rogers, and I went straight into the business from Columbia and worked with Tiger as a retail and consumer analyst, and that's all I've ever done for the last 30 years. And now I run my own private capital, and this day is really a highlight of my year. I love coming back, and I'm just every year, like Bill says, blown away by your presentations. So know that this doesn't go unnoticed, and thank you to Bill, and thank you to Pershing Square for including me.
Thanks so much. And then Eric Rubin. So you'll note that Eric looks a little more casually dressed. Go ahead, stand up.
Yeah. I'll introduce myself. As a last second invite, we played tennis this morning, but actually was captain of the tennis team here, so as undergrad. Did a couple years in finance at Goldman, built startups my whole career, and now recently launched my own venture capital fund. So excited to hear all the public market pitches. Excited.
Okay, great. So we're going to pick a couple winners. Sometimes it's 2, sometimes we can't decide, so we have 3. The prize is $150,000. We decide how to allocate it to 1, 2, and 3 based on science. And then you get to decide to do with the money. Now, people have typically given half to a Columbia University-related cause, and they've kept half, but we're not requiring that. If you're disappointed with Columbia in any way and you just want to keep the money, that's totally fine with us. So with that, look forward to press.
Come on down. And, yes. All right, guys are, I will give you a 2-minute warning and a 1-minute warning, and you'll have 10 minutes.
Does this work? Sweet, test it.
Test.
We recommend a short position in AppFolio, trading today at $220 a share with a March 2026 price target of $143 a share, representing a 35% upside and 40% IRR opportunity.
Introducing the company, AppFolio is a provider of cloud-based software for real estate property management. The company generates revenue from 2 categories of services: core services for property-level financial accounting, which generate about a quarter of revenues, and value-added services, mainly consisting of payment processing fees, which generate 3/4 of revenue. The company is 100% US-based.
Since 2015, AppFolio has beaten industry benchmarks. The company scaled to become a leading provider of property management software. The AppFolio long thesis is predicated on product market fit with small medium businesses, elevated volume growth over the last 2 decades, all leading to a premium valuation at roughly 8.5 times forward revenue.
Since 2020, the company has grown revenues annually by 26.5%, driven by both volume and pricing. Critically, the street assumes that this rate of growth will continue in the future.
After a long winning streak, we think AppFolio has reached an inflection point and will be challenged to meet consensus targets. AppFolio's short thesis is predicated on a unit growth miss, value-added expectations coming down, and a limited menu of growth levers. Our IRR bridge has an 8% revenue miss, resulting in an outsized multiple compression, given that the company trades on forward revenue.
Unit growth at AppFolio has been decelerating due to a combination of lower net new unit adds and AppFolio's continued focus in the small to medium landlord space. In the top left, you'll see that average unit growth was about 7.5% last year, a notable deceleration from historic trends. When looking at the number of net new units added, net new units were at 600,000 in 2024, a noticeable 40% drop from their 2022 peak. At the bottom right, we think this is largely a focus of AppFolio remaining concentrated in the small to medium landlord space. Our research crystallized that AppFolio is competing for share within a saturated market that has robust competition. On the left-hand side, we've broken out the US rental market into 2 main categories. Out of 50 million rental units that exist today, about 30 million units are serviced by AppFolio or one of AppFolio's 3 major competitors, Yardi, RealPage, or Entrata. Our research indicates that AppFolio faces stiff competition from all ends. Of the 15 million units that remain offline, it may still seem like there is meaningful white space. However, our research indicates that these offline units are likely belong to a long tail of SMB managers that don't have an imminent need for AppFolio solutions. We think the competitive dynamics will only intensify and dampen AppFolio's volume growth prospects going forward for 3 key reasons. First, AppFolio's end markets are much more mature than people realize. Despite attempts to move up market, AppFolio remains 100% concentrated on residential property managers in the United States. There's no corporate business and no international segment. Second, the profile of the incremental buyer has changed. Instead of looking to sign up property managers who were previously offline, AppFolio now has to target customers already serviced by another solution. Customer churn in this industry is really low. Our research indicates that churn for this type of software is in the mid to low single digits. And third, we think AppFolio's competitors are well capitalized and that the competitive dynamics going forward will only intensify. Bringing it all together, our new unit analysis suggests that volume growth will converge to the low single digits and miss consensus estimates by at least 3%. We've broken out the number of new units that AppFolio can add into 2 main categories. First, looking at the number of new units moving from offline to online solutions, whether it's AppFolio or one of AppFolio's competitors. And then second, the number of new units that AppFolio wins from competitor churn. Using a set of reasonable assumptions, we conclude that AppFolio's implied volume growth over the next 3 years looks to be in the mid to low single digits. We have 4%. Notably, this is about 3 to 3.5 points below consensus estimates over the next 3 years.
After a recent period of elevated growth, the street believes that the value-add segment will be AppFolio's long-term growth engine. Consensus views of this segment include a diversified mix of services providers, upselling capabilities beyond basic software solutions, and pricing power with the ability to monetize these new services at meaningful scale. Our diligence led us to conclude that the value-add business primarily reflects suboptimal pass-through fees on tenant rent payments. Using historical fee schedules, we estimated the portion of value-add revenues that are coming from these tenant fee payments. We found that in 2024, roughly 65% of the segment came from payments. Though these fees are common in the industry, it's a lower quality revenue stream compared to the other portions within the segment. These ACH fees have been driving recent acceleration in value-add segment growth, which we'll discuss in the next page. In 2023, AppFolio introduced a $2 fee on all ACH payments. Without it, we think the pricing growth will regress to normalized levels. When applied to AppFolio's broad customer base, the seemingly small $2 a month fee is charged to millions of customers transacting monthly rent. This fee was unexpected given that AppFolio's main competitors, Yardi and RealPage, don't charge for ACH payments. We think this ACH fee is a one-time land grab masking a weakening growth outlook. In the chart below, you could see growth with the ACH fee and without the ACH fee, which is roughly mid-single digits.
We believe that future pricing growth in the value-added services business will be driven by non-payments revenues going forward. This normalization will lead to a 2.5% missed consensus. On the bridge below, you'll see on the left-hand side of the page the building blocks of AppFolio's pricing growth over the last 3 years. Notably, the one-time lift from the ACH fee accounts for our estimates half of that pricing growth. Going forward, we've removed the benefit of the one-time ACH fee from our estimates and in addition accounted for some other normalized pricing, which in turn leads to our estimates for 7% pricing growth in the value-added services business, which is notably 2.5 points below consensus over the next 3 years.
Our research demonstrated that the ACH fee hike deteriorated relationships with the property manager community. We even found that property managers totaling 1 million units formed a WhatsApp group to coordinate opposition to further price hikes. Furthermore, we believe that raising prices in the core solutions is going to be an uphill battle. The reason being that if you look at historical core ARPU growth, it has only averaged around 2%, demonstrating that customers had either no budget or no need for more advanced capabilities. Our research indicates that AppFolio already prices ahead of peers Yardi and RealPage, suggesting that the company will have limited room to take additional pricing on a go-forward basis. Furthermore, the fact that the majority of AppFolio's revenue comes from value-added services, which are intrinsically low margin due to their pass-through nature, means that the company will have limited ability to increase its margins as it scales. On this page, we use the framework of a simplified financial model to estimate the multiple that could be justified for AppFolio under various unit growth and ARPU assumptions. What we find is that in order to justify the current 8.5 times EV to revenue multiple, you need to believe that AppFolio will get 33% market share of all US rentals, including currently offline units, and also double its ARPU.
We believe that continued decel in unit count growth and more normalized pricing increases will result in a miss to consensus revenues. Here you can see our revenue driver assumptions as well as variance to consensus in the various segments. On the bottom, you can see our top line variance, which is 3% in 2025 and 8% in 2026. We also ran a 7-year DCF through 2031, which indicates that AppFolio trades at a 36% premium relative to intrinsic value.
On the upper left of this page, we triangulate our DCF valuation with a multiples-based approach. Our base case valuation, or base case price target for AppFolio, uses operating model revenues and attaches a 5 times revenue multiple to arrive at a $143 per share price based on our fundamental analysis of what multiple we can justify. In the downside case for the short position, we use the current EV to revenue multiple of 8.5 and consensus revenues to simulate a scenario where AppFolio where re-rating is delayed as AppFolio continues to perform against consensus targets. And finally, in a bear case, we assume a still healthy level of revenue growth and a lower EV to revenue multiple. What we find is that in our base case, an AppFolio short position could generate a 39% IRR. If everything goes right, an AppFolio short position could generate a 49% IRR. But importantly, if we're wrong, we could only generate a negative 20% IRR, suggesting an asymmetric set of outcomes to a short position.
In conclusion, we think AppFolio bears many hallmarks of a good short. First, we'd argue the stock is priced to perfection, and expectations are at a high relative to the fundamentals of the business. Second, we've seen this story before. The market's been slow to process AppFolio's transition to maturity, and there's a myriad of vertical software companies that have endured painful re-ratings. Last, we'd like to flag that you're paid to wait, as the short collateral would generate additional interest not considered in this investment case. Moreover, we'd like to flag that AppFolio reported Q1 revenues just yesterday, and on a 1% unit miss and a 1% revenue miss, the stock is down 15%. We've also flagged some additional risks and mitigants, but at this point, we'd like to open it up for questions. Thank you.
This is a great presentation. Congratulations. Could you talk a little bit more about the management's history, and also with respect to revenue recognition, I think that it has a history of aggressive revenue recognition. So if you could talk to sort of how that's looked historically with and without the value plus.
Yeah, so, you know, the first thing is I believe this company was spun out of an incubator, IGSB. The current, I think right now the current CFO is actually an interim CFO. The previous CFO stepped down relatively recently. They're still conducting a search for the permanent CFO. So Shane Trigg joined in 2020. He was part of this kind of push to get the company to, rationalize its cost structure, as many, SaaS companies have aimed to do recently.
And then just on billing, so the company bills its customers on a monthly basis, so there's not any ASC 606, software billings accounting that you have to account for with other providers. They bill their customers on a monthly basis, so there's a pretty true sense of the revenue from that. Our larger comment on the revenue is that we think with ACH there was this one-time land grab. It's a fee that none of their other competitors charge, and when the company reports their revenue, one of the areas that we had to kind of research intensively was just how much of the value-added services revenue was related to payments versus everything else, because the company doesn't disclose that.
Sorry, how much does the management own of the company, and have they been selling?
Sure, so we have a slide on insider sales. So management owns a relatively small portion of the company today. At this point, none of the current management team are the existing founders. IGSB incubated this company and still owns a pretty large stake, about 25%. And they're very involved in running of the business as well. So I think they have 2 to 3 board seats. We'd also like to flag, just because you mentioned it, on insider sales. 2024 was a big year for insider sales. Insiders sold 185 million in shares, and we'd like to say that the average price was $241 a share, a notable premium to today.
Thank you for the presentation. I thought it was really well done. I think I largely agree with the revenue story. I think, the one-time ACH fees, it's a maturing industry, so I think naturally there's going to be slowdown, and sometimes consensus is kind of slow to price that in. I guess my question is more on the margin structure. So I'm just curious, I know it's a company that trades on revenue, but if I look at your financial projections, you guys are about, I think, like 11, 12% below consensus on like 2027 revenue, let's say. But interestingly, your EBIT, so your EBIT margin and your EBIT dollars are like more than 15% higher than consensus. So I'm curious if you could just talk through kind of the margin structure of this company and kind of where you differ versus consensus.
Yeah, so, we did a lot of work on the margin structure of this company. So I think the key thing is just looking at, cost of revenue, how much of that is really fixed versus variable in nature. The key thing with AppFolio is that the cost of revenue that they report includes both a component that's, hosting expenses, things that should be fixed in nature, but it really also includes this variable component, which is, the cost of support personnel, people that, support the various landlords and users of their products. And we actually think that's been variable in nature. It's historically been variable in nature and will continue to be so going forward. We think the approach that consensus is using is basically just to treat cost of revenue as entirely variable. We think that approach misses a lot of, important detail. Just on kind of the comparison to consensus, as you mentioned, this company, it does trade essentially on revenue from what we can tell. We think our EBIT projections are slightly higher than consensus in kind of the medium term, but I believe in the out years, EBIT and especially net income and EPS start to fall below consensus levels. And I think one of the key things to note is just even if you do believe kind of the consensus revenue trajectory, you can just look at kind of the multiples on FY4 and farther out price to earnings multiples. And you see that this company is not really generating enough operating leverage to justify trading at the place where it is. Even the multiple on 4 years out continues to look expensive. So in general, what we think is that as you roll forward, people realize there's not that much leverage in this business. Those estimates will come down or eventually be priced into the stock.
Okay.
Congratulations. It looks like the stock is down 15% and it's holding, so this is definitely.
You have to flip the switch.
Hello, okay. Congratulations. So I checked, the stock is down 15% and it's holding, so that's a great sign. You mentioned a WhatsApp group. Can you talk a little about what you heard in there and how did you find it, through Reddit? And maybe delve into that a little.
Sure. So we heard about the WhatsApp group from interviews. The interview was with an NYC property manager who manages about 5,000 AppFolio units in New York City. And so the conversations around what the WhatsApp group was formed in 2023 after the implementation of the ACH fee. Now, you could imagine why property managers were incredibly frustrated because ACH has, almost no marginal cost, right? So it's essentially price taking from AppFolio, and also it's against industry standards. So none of their other competitors charge it. Going forward on the ACH fee, the landlords have kind of gathered together. This WhatsApp group exists. There's the property managers of 1 million units that are in this WhatsApp group now. And where we've seen this pushback kind of going forward is that the company actually in 2024 reduced their fees that they charged on credit card transactions. I think previously they were charging 2.5% on credit card payments, so the payment that goes from the tenant to the property manager, and they've lowered that pricing down to 2%. So there's signs and additional evidence that there's been continued pushback. One of the other areas where the reporting's light, and we've tried to dig into the best where we could, is just on the number of net new units added in fiscal year 24 being lower at 600,000 units. We believe there's some additional property manager churn embedded within that number, but unfortunately, the limits of our diligence, we didn't meet any property managers along the way who churned out of AppFolio and onto like Yardi or RealPage, but we know also that Yardi and RealPage are going after AppFolio's customers on that basis.
What work have you done on kind of the quality of their product or their offering versus the competition? I mean, do they have a better offering? Do they have sort of new module coming that could help them versus competitors?
Sure, yeah, just pull up.
What enabled the growth of the previous one?
Sure. So we would argue, so this page here is the competitor overview. So we've laid out just, there's more kind of biographical information on the page before, but this is the page that really cements like the services that are offered on AppFolio versus other solutions. AppFolio has always been and continues to be targeted at small to medium-sized landlords. And that's somewhat reflective of the types of properties that they serve. So noticeably, you see that there's no commercial properties, there's no commercial Class A properties, affordable housing, the solutions are less robust. And
when you say commercial properties, you mean what?
Any property where tenants are not residents, but instead they are a business that pays monthly rent. And the primary difference is that
office and retail.
Exactly, office and retail space.
Things priced on square foot.
So they've served a very different customer base. Now, for that customer base that they have served historically, initially the product was really, really good. So what they did initially was they were competing primarily against Yardi and RealPage and clunkier versions of those old systems and winning a lot of customers from that. So when you look at the historic volume growth over like a 15 to 20 year period, it's pretty robust, right? But as they continue to go up market, management's been talking about this move up market now for the last almost 10 years, like the first earnings clips, from 2017 talk about this move up market. They've struggled to do that. We would argue that if you look at the key software features, that's largely a function of the software being either on par or slightly below par for the needs of a much larger property manager. So when you kind of click through the list, like one of the things that's really important to larger property managers is like box score reporting. So property managers will have like customized reporting that's built out, and Yardi's really good at this, where they'll have customized reporting built out with like all of the key return metrics. So not just the basic rent roll stats, but in addition, it's a bunch of like operational and financial return metrics also embedded in there. AppFolio does not have that functionality, and that's one of the reasons that AppFolio continues to maintain like a lower share of the market, and Yardi continues to defend its turf.
And one thing to note is that another set of competitors that they used to compete against that they can't really extract more ads from was QuickBooks and Excel. So these kind of ad hoc solutions that weren't really geared for real estate customers to begin with.
Yeah, and then just one other point on like the down market. Entrata is one of the other competitors. They service about 3 million units. Entrata was actually a spin out of Yardi, and Yardi spun them out on like antitrust concerns, and we're happy to get into that. Entrata has garnered 3 million units in a relatively short amount of time, specifically by targeting student housing at the start, but they've quickly moved into other markets as well. So other competitors have been able to innovate, and AppFolio kind of continues to remain pigeonholed in that small to medium landlord space. Sorry. Yeah.
Flip the switch up.
I should know. Mike's. So thank you very much. It's very, very good, especially this page comparing competitors. I've invested in a lot of software companies. I've never seen this company before, but just a couple of things that I quickly look at, questions that I have. First is, what's the customer churn on the business?
Yeah, so the company doesn't release a number, but we think that it's actually comparatively high just by virtue of targeting SMB customers who just naturally churn more often as businesses come and go. Two, the second thing is that just the nature of real estate. These solutions can be relatively discrete. There are some examples of customers using both Yardi and AppFolio. So we think that customers actually have some level of flexibility to change between solutions. And
Do they ever provide a churn rate?
they do not release a churn rate.
They don't release a churn. We've spoke to one of the former finance managers of FP&A, and when we spoke to that person, we just asked historically what the number was, and they were aligned that it's like mid to low single digits. But more specific than that,
Mid to
we don't
low
know.
single digits?
Yes.
So low is very good. Mid is, it's getting worse. But then next question is, with respect,
Al, you got 1 minute. I want to let Dennis get a question in too.
very quick, on, a lot of the focus is on the revenue multiple. Let's talk about just some other things like sales and marketing as a percentage of revenue. Have you guys looked at that and compared that to others? Because I always use that as a
Stable.
quick way to sense, if their sales and marketing is low and growth is decent, that's a pretty attractive, potential business.
Yeah, so I mean, what you can see is that sales and marketing is actually slightly lower than peers, but growth is also decelerating. That's the important thing. So we see the 2-year forward growth just based on comparing our numbers to consensus for the peers is actually below
good,
average. So.
Okay, thank you. That's very helpful.
And mind you, the company trades at a premium on gross profit. So if we do see a re-rating to peer multiples on that sort of metric as this company matures, then it would be significant.
Okay, Dennis, quick question.
Yeah, just very quickly, if you could talk a little bit more about, some of the grassroots kind of pedestrian research you've done. Have you looked at the auditing fees that they're higher than some of the competitors? Have you requested from the Freedom of Information Act, were there complaints about this company and things of that nature? That'd be great, thanks.
Yeah, so we spoke to some formers from a bunch of in particular from AppFolio, and in particular somebody who worked at both AppFolio and Yardi, and kind of echoed a lot of the things we say. It doesn't take that long to onboard somebody or to move between solutions. There was significant, pushback, just from, landlord community, the property manager community, people complaining about AppFolio's fees, and some of that was noted by Yardi as a competitor.
And then just one other point on the differentiated research, we went across, our resident tenant portal. Some of us use ClickPage, which is, provided by RealPage, ClickPay, which is provided by RealPage, and we manually scrubbed, all of the different fee schedules and, as in particular the fee schedules on the rent payments, and kind of like, toggled, for example, what if we paid by ACH versus credit card on like a ClickPay platform, and same goes for Yardi as well. So a lot of internet scraping as well for data.
Thank you so much.
Thank you.
Team 2. I'll be here, I'll give you a 2-minute time. Give it to a 9. There's the turn on button.
Test. Test.
Test. I'm Dimitri, and I'm here with Tuan and Eric to present Carlisle as a loan with a target price of $568 per share, which was 64% upside and a 20% 3-year IRR. This is a $16 billion US company that is really covered by just 4 or 5 main analysts. Carlisle is benefiting from structural organic growth tailwinds and will not only beat consensus expectations, but also management's targets. The core business has more than doubled EBITDA margins over the last decade. So given this impressive performance, the market is expecting Carlisle to mean revert. Having spoken to more than 70 people across the value chain, we believe that this margin performance is going to prove to be durable, and that the management team has been investing prudently to support the next stage of the story. This opportunity is really easy to miss if you're not in the roofing trade. Carlisle offers a 3-to-1 risk-reward for a market share leader operating as a replacement business in the commercial roofing market. So, and management have been willing to divest all non-core assets to focus on just the 2 highest return segments, which is a transformation that's been largely missed by the investment community. Roofing products have been manufactured locally in the US for the last 100 years. And today, there are 4 main players in US commercial roofing, of which 2 are private players and 1 is a European conglomerate, which is why Carlisle is really the only company with this level of focus. Our first thesis point is on the revenue growth opportunity. And this is a much less cyclical business than you might expect, as most sales are repair and replacement and primarily non-discretionary. To put it simply, Carlisle sells roofing systems with warranties, and a new player would have to manufacture almost all the individual components to be able to provide this full 20, 30-year warranty to compete effectively. Tariff risk and terminal risk are low, and a final point to highlight is that there's just a certain number of roofs that must be replaced every single year, which provides a stable, recurring, and annuity-like demand.
And we think consensus is not appreciating the annuity-like qualities of Carlisle. In management's Vision 2030, they're pointing to 5% plus organic revenue growth. And looking back at history, Carlisle's grown at 10% on average, with 6 points coming from purely organic growth. Over our best through-cycle estimate, we see that is closer to 5%. And re-roofing demand is strong and only growing stronger as the mid-2000s construction boom combines with an aging stock that's increasingly approaching its warranty expiration date. To better understand the macro picture, we dove into US Census and EIA survey microdata, and the first thing we noticed was the spike in commercial construction spending in the early and mid-2000s, which now points to 1/3 of the commercial building stock waiting in a growing lineup for their first roof replacement. In addition, we learned that the average age of the US commercial building stock is now over 50 years on average, which combined with looking into Carlisle's warranty data, which suggests that most re-roofs are second or third time jobs, further supports the recurring nature of this industry and gives us further confidence in our views on base demand. We think that conservatively, this growing first-time re-roofing backlog adds 1 to 2 percentage points to incremental growth on top of our 6% long-term average. The education end market is often used to highlight flagship projects, and at one of the trade shows that we attended, we learned that Columbia is actually a recent Carlisle customer, specifically for the roof that we're all under right now. And over the last 20 years, Columbia has engaged in 98 capital projects, of which only 5 have involved roofing. And so across the 300 plus building portfolio, this points to a wave of imminent demand in the years to come. Both new construction and renovations are subject to increasingly higher standards for building insulation, which is roughly 1/3 of Carlisle's commercial business. Energy codes have become significantly stricter over the past decade, and more asset managers are focused on driving down energy costs. This has resulted in an increase in average thickness per square foot of roof per insulation of roughly 50%, leading to an increase in insulation content per installation, which further supports our estimate of 6% growth and is beyond management expectations. We independently confirmed that this is not driven purely by regulation, but also by financial incentives, as more insulation drives further insulation benefit and drives a positive ROI over the life of the roof.
Moving on to the second thesis point around margin expansion. To quote a CEO of a large regional contractor, roofing is one of the few trades where the manufacturer effectively controls the industry. Now, the industry has seen significant consolidation across both the manufacturer and distributor levels, with the two maintaining a highly symbiotic relationship to sell into a fragmented end customer base. This tight-knit relationship, combined with high switching costs for contractors and building specifiers, underpins the deep competitive moat around the business for Carlisle. Now, in the past, margins have expanded due to greater industry consolidation, positive mix benefits, as well as the significant shift from individual component sales to full system sales. Going forward, we believe the conditions are in place for a more disciplined pricing environment, accelerating mix benefits, and increasing scale advantages that will all help Carlisle resist margin aversion to the low 20s. Now, over the past 30 years, there's been a broad shift in the industry from asphalt-based roofing to single-ply systems, largely driven by Carlisle's innovations. Through the 2010s, competitors with legacy asphalt businesses cut pricing to gain foothold in the market, which partially led to the negative pricing that you see here in this chart. Now, leading up to and through COVID, there were a few important changes that have paved the way for rational pricing going forward. First, Carlisle steered the industry away from pricing to cost to pricing to value. Second, the number 2 player, Firestone, which is now Elevate, was acquired by Wholesome in early 2021 and has refocused priorities from growing volume to closing the margin gap with Carlisle. And third, the former head of Carlisle's roofing business, who was instilled with the pricing to value philosophy, was hired to lead GAF, the number 4 player's commercial roofing business, also in 2021. Now, these key changes have been missed by the market, in part due to the noise created around COVID. But what you've seen is that the top 4 players commanding over 80% market share have been pricing in close lockstep. And we believe this dynamic will continue, and given the pricing, will be a larger component of future growth and drop through to margins.
The second prong of our margin thesis is that in Carlisle's larger segment, CCM, the most margin accretive subsegments are still growing fast. We tracked additions to this business, and according to the management transcripts, we're seeing across 85% of the business, EBITDA margins in excess of 30%, with the rest growing quickly as they scale. The margin support comes not only from the composition of business within CCM, but also from the composition of materials within a typical roofing system. Over the past 15 years, roofing sales have shifted largely to system selling, which is more margin accretive. And given the tailwinds we pointed to earlier, we see a higher mix coming from insulation and accessories, which not only increases margin, but also expands growth beyond that of the top layer of the roofing system. The next major shift will be cross-selling across a broader building envelope. Cross-selling of multiple integrated systems across the building envelope further supports margin, and Carlisle has already been making smart acquisitions to support these initiatives. For example, the combination of CWT with Henry has led to 800 basis points of margin expansion in just 3 years through cross-selling, purchasing synergies, and economies of scale. We think that Carlisle will continue to dominate in waterproofing, and that's compared to less focused, smaller competitors.
Moving on to our last thesis point around management and capital allocation. Management has proven themselves to be superior capital allocators. Since 2016, management has meaningfully simplified the business down from a diversified conglomerate with 5 unrelated segments to the single highest return building product segment. Now, it's impressive that the leadership team decided to prune the portfolio and focus in on this segment. Now, what the average observer may not realize is over the past 30 years, this building product segment has earned over 20% returns. Capital allocation has been entirely focused on shareholder returns, with nearly $5 billion used to buy back a third of outstanding shares. Assuming the same historical allocation of 42% cash to buybacks, at today's price, Carlisle can retire a further 14% of share count from internal cash flow alone in the next 3 years.
The market is focused on 3 main risks: volumes, margin, and Kingspan's imminent entry. Given our thesis, we think there are logical mitigating factors to each of these. A unique risk is the pending acquisition of Beacon by QXO, and we were initially concerned. However, having listened to Brad Jacobs' plan to drive profitability, he wants to do this by focusing on the larger vendors, and we think this could well benefit the manufacturers such as Carlisle and deepen the existing relationships. Given local-for-local production and limited non-US procurement of raw materials, we echo the CEO's comments that the tariff risk is very low. There are indeed some inputs that will be impacted by tariffs, but in the past, Carlisle has been able to pass through raw material increases within 18 to 24 months and then retain margins when costs go back down, even in the 2010s. If tariffs contribute to causing a recession, that risk is real, and we have some scenarios and historical case studies to highlight ways that the business can be resilient. So with that, we see multiple realistic paths to a high teens IRR led by strong organic growth for a business with minimal terminal risk, and we look forward to your questions.
How do you think about the recent tariffs and the potential for a deferral of CapEx, and what impact do you think that might have on the business?
Yeah, thank you for the question. So in terms of the tariffs, I think the direct impact from tariffs is low given the 90% procurement in the US. Now to your question on the deferral of potential projects, I think how we've thought about that is pent-up demand backlog from the 2000s as described, and then residual deferrals from COVID, because during COVID you couldn't re-roof, and when you could begin to re-roof, there was a large supply chain disruption and materials shortage. So what you're seeing now when you talk to a lot of contractors at these trade shows is that the demand for repair and replacement is still very robust. Although we all know that new construction has been soft the past couple of years. So it really over the past few years, the volume growth has really been driven by the R&R, and we think that pent-up demand really will help insulate the business.
And one
On the mix for them, how much is repair and replacement versus new build?
Yeah.
80-20 roughly.
So for Carlisle CCM, which is the majority of operating profit, 85%, it's actually higher than the number Eric is even quoting. Yeah. So it's 85 to 90%.
Thank you. Other questions? Dennis?
Just two
Quick questions. The first is how much of the value of the business based on the subsector, a macro call? In other words, if things going well, all the other competitors is going to do well. How have this company done during downturns? Have they increased market share? And the other question, I'm just trying to figure out: are you pricing this company or are you valuing it? In other words, I notice I use EBITDA as a valuation. Why not GAAP earnings? What's understated with GAAP earnings that you wouldn't use that? Or I think you did use that, but could you talk a little bit about your valuation versus pricing the company?
Yeah. Can we talk about recession first and then we'll do valuation?
Yeah, in terms of recession, we have some case studies that we look back, during the GFC, 24% revenue decline due to the nature of this business being highly variable cost nature, 70 to 75% of COGS is variable. And then on a total cost structure basis, roughly 60% is variable, which is why you see, 4% decline in the 2008 time period. So that really gives that resilience for the business as well. The variable cost nature is also primarily petrochemical derivatives. So in a future recession, if oil collapses as well, that's where you get the price cost benefit. And then
on the market share point, it's actually very difficult to tell what the market share is over time. So we give a best estimate today. But as we said, you have Carlisle data, you have Holcim that used to have this solution and products business that includes the European business. And now that they're spinning off this year, they give you the building envelope business that will be their North American Amrise. But for example, for GAF, we couldn't find any data historically consistently. And for Johns Manville, we could get the revenue, but we could get it by tracking people retiring from Johns Manville. And sometimes they post on LinkedIn how big the business was the date they retired. Then your question was on valuation. So our central valuation is using a PE multiple on GAAP earnings. And we just also showed how you could triangulate to through many kind of different types of valuation technique, that this is indeed cheap today. But that said, we're basically talking about a business that, if we're right, is growing EPS at mid-teens and is trading well below the S&P average.
And just one more point on the market share standpoint. We really tried to dig in and figure out if there were any market share shifts. Taking CEO and management team comments at face value, market share stability, at least over the recent years, seems to be stable. But when you talk to customers, distributors, and you ask them, what has the market share been like over the past 10, 15, 20 years? They say that Carlisle has always been number one, and then Firestone number two. So there's that market share stability over that many decades.
Kat?
This is a really interesting business. So roofing. My question is, what are the opportunities for roll-up of mom and pop shops in this industry? The reason I ask is that I was stuck in a hotel last summer with the Mom and Shop National Roofing Convention, and there's an enormous amount of pride. I was just listening into their conversations in the industry, and the companies go from generation to generation, and is that an opportunity for them?
Well, let's talk about the track record and then.
Yeah. So I guess with Carlisle's focus being on expanding their reach into a broader definition of what they call a roofing system and now into a building envelope, they have made a series of acquisitions over the past decade. And these aren't necessarily mom and pop size businesses, but they're acquiring them in a smart way. They're able to pay a fair price for them and achieve like reasonable, if not really significant synergy value post-acquisition, with probably the best case study being that of Henry. So you're looking to acquire anywhere from 10 to 12 times EBITDA, and then with synergies and integration, it's somewhere closer to 7 to 9 on average.
And this is an industry where M&A has historically been part of the strategy, and for Carlisle, it remains the strategy. The shift is kind of, as Eric was describing in his section, was they're now more focused on the weatherproofing, waterproofing part, and adding to the next kind of building systems that they will be selling as a full solution.
Go ahead.
Great presentation. Oh. Okay, there we go. So I was interested in the comment that they've pruned the portfolio, so they have the highest ROIC. Can you talk to cash conversion and what the impact of the increase in the system selling is going to have? And maybe if you can go back and look at sort of how the cash conversion has looked over periods of prior recessions on the business.
Yeah, that's a great question. Thank you. Yeah, we look back at cash conversion, and it's a little bit noisy given that they've divested a lot of these unrelated segments. But what you'll see when you look into the different metrics is that over time it has gone down. And today, cash conversion is about 60 to 65 days. Yeah.
If you can speak to technology in the industry, I didn't completely understand this. How much of the business is installing a roofing system that's developed by someone else, and how much of it is proprietary to them in terms of the design of the product? Do they manufacture their own roofing system?
Yes. Yeah, it's a great question. And to that end, Carlisle very much manufactures all the most of the roofing system. The only parts that they don't manufacture are the mechanical fasteners. So that kind of lies to the technological advantage that they have, as well as the very large cost advantage that they've developed over time. And maybe slide on the margin gap between Carlisle versus the next closest competitors. What you've seen, when you look back at the history and you look back at the culture and the operating system, they have what's called the Carlisle operating system, which it's actually they mirror Danaher Business System, Toyota, and Lean, and they've adopted that in 2008. And over time, what you see is you can track, and it's about 1 to 2% savings that they target.
But to clear up one piece of confusion, if that's okay, Carlisle are not the ones who are installing the roofing system. They are purely the manufacturer. This gets distributed through a specialist distributor who works very closely with Carlisle, and it's an entirely separate contractor who usually has to have been certified by Carlisle that they can install this correctly, and then that's why Carlisle will guarantee this huge 20, 30-year warranty for them. So you and I could not become, a contractor today and go install Carlisle.
And so I know I have a better understanding of the business. What's the risk of a competitor? What are they spending on R&D versus competitors? What's the risk of a competitor introducing a better product? How much innovation is there?
I think one part we can start with is that Carlisle, they effectively introduced this product that is now the main thing that's being sold in the industry. Over the years, they've iterated on that and added quite a bit to that across their portfolio by expanding across the whole building system. And I guess maybe go ahead.
I think today it's really interesting. This is a very standardized product that the top 4 players manufacture to almost the same quality. But what determines whether it's installed is that relationship with the contractor, architect, and specifier. And for example, whether you're on Columbia's spec sheet and approved vendor list or not. So Columbia's director of trades, who used to manage Capital One's 500 building portfolio, he would have 2 names on his spec sheet, one of which would be Carlisle and one would be a local alternative. And 80% of that volume for him would go to Carlisle. So from an R&D perspective, this is a business that spends 1% of sales today on R&D. They're talking about increasing it to 3% through 2030. But the real innovations now are about labor savings. This is an extremely labor-constrained industry, and it's about can you fasten and deploy the single-ply roofing easily when you have very few workers available.
Do you want to answer your question?
Oh, sure. My question was just on pricing. So it looks like they took a lot of price in 2022, and I was looking through your income statement, and I had assumed that was just kind of passing through inflation. It was a very inflationary time, but it looks like they just gouged for whatever reason, and like margins
from 2016 to 2021 were always between 11 and 15%. Now margins are in the low 20s. Just after that one price increase, I would imagine that was the sole driver of it. What's your confidence that margins won't revert due to competitor dynamics, customer pushback? You have a lot of pressures on budgets now with tariffs, et cetera. So.
Yeah, that's a very good question. That's the question that we've been asking ourselves throughout this whole research. And I think there's a few levers to this where we think, so, first off, to answer your question, 22, they did take a lot of price. And that was a function of supply chain materials shortage. And then being able to, as an industry, they really were able to take price. In terms of going forward, what the margin profile may look like, we think that one is incremental margins on subsegments. Right now, 40% for the main business, for large business, and 30% for the smaller business, CWC, which today the existing margins are about 30%, 26 to 30% for the total business.
And I have one important clarification. The number you're quoting for us is the whole business, I believe.
Yeah.
So Carlisle 2011 had 9 segments, 2016 had 5, and today is just 2. So the actual margin progression is this one that we have on this slide, where they have actually had meaningful margin increases over time since after recovering from the financial crisis.
Still like a 600 basis points.
That's true, right. But that's what you get when you have 26%.
Very unusual for a company like this in this kind of an industry to do a massive price increase because of the risk of, how do the customers respond to that?
Across the value chain, it's actually kind of an interesting setup. Manufacturers increase price, distributors are happy to pass that along. They price off of a markup. Contractors are also pricing off of a markup, so they're passing it along to the end building owner. The building owner doesn't really see the sticker shock of this because they're only
Project every 25 years.
Yeah, so it's a unique environment for pricing.
And even though it's a big ticket item for the year, it's actually quite a low proportion of the total maintenance of the building. And it doesn't happen that often. You have good visibility, you start planning ahead for when your warranty is expiring, and you have some temporary solutions as well.
Thank you so much.
Thank you.
All right. Great.
Hello? Okay, I think did that work? Yeah.
Good afternoon, everyone. I'm William, and with me are my friends Dennis and Leia, and we are recommending e.l.f. Beauty as a long with a March 2028 price target of $108, 96% upside, and a 26% IRR. Here's what the market is missing about e.l.f. Beauty. Tariff concerns are overblown, the company is a consistent market share gainer, and they have the opportunity for margin expansion with increasing scale. e.l.f. Beauty is a cosmetics and skincare company focused on making high-quality formulations at accessible price points for every eye, lip, face, and skin aspiration. They are a digitally native brand with a direct consumer offering through their website, as well as a membership club called Beauty Squad with over 5 million members. They have retail distribution within Target, Walmart, Ulta, CVS, and Dollar General, among others. We believe that e.l.f. positively differentiates their products on 4 key aspects: quality, newness, price, and accessibility. 2025 has not been kind to e.l.f. stock, but we believe the negative sentiment may have overrun the long-term potential of this business. Between the tariff announcements and a weakening of the consumer in the first quarter of fiscal year 2025, the news has not been good for e.l.f. Since the Liberation Day announcement on April 2nd, the stock bottomed at $49.63 on April 16th. Why is e.l.f. a buy? The recent sell-off we just discussed provides an attractive entry point to own an innovative, durable, and high-growth beauty brand at a near historically low valuation multiple. We think that the sentiment overhang generated by the growth deceleration, the tariffs, and challenges in the broader category present room for a misunderstanding and gave us an opportunity to form a variant view on the stock. Multiple catalysts, such as shelf space expansion, new retail partnerships, and international growth, present the potential for an asymmetric upside opportunity. We gained confidence in our thesis through primary research opportunities, such as retailer store visits, a large survey of Gen Z and millennial consumers attending the CBS Beauty Conference, and connections with corporate buyers at Target and Walmart, among others. Our investment thesis rests upon three main pillars. We believe that e.l.f. is a 20-year brand showcasing a durable franchise. They have the expanded availability within retail stores going forward that will allow them to grow sales at mid-teens rates, as well as increasing scale that will drive margin expansion into the future. Speaking a bit more on the durability of the brand, this is a 20-year brand that recently reached billion-dollar revenue scale and shows continued strength as showcased on the left side of the page. They've continued to gain market share, and their Google search trends and Beauty Squad loyalty membership are all inflecting positively over the last 5 years, with the membership program more than tripling over that time period.
Now, the street expects e.l.f.'s high growth to drop off as what they believe to be a fad dies down. What they're missing is that e.l.f.'s growth is not driven by any particular TikTok trend or product launch, but by their innovation. As the company has grown, the innovation engine when it comes to marketing and product development has remained top tier, which leads us to believe in the durability of the brand. So starting with the marketing, even as e.l.f. has increased the marketing spend, each year, every marketing dollar is driving more and more incremental revenue, which points to the effectiveness of their marketing campaigns and partnerships. Now moving to product development, e.l.f.'s product development timeline is faster than all of its beauty peers, which allows them to stay nimble and quickly pivot to launch products that are trending as others lag behind. Now underpinning our confidence in the durability of this brand are e.l.f.'s Holy Grails, which form the majority of the revenue base. These are product lines that are already known and loved by consumers because of their high quality and their low price. Based on our consumer survey, we found that lower price for a similar quality is the #1 reason why consumers switch from one beauty brand to another. And looking at the Holy Grails, their quality to price is unmatched. So the Holy Grails are going to continue to resonate with consumers and continue to drive growth for the brand moving forward.
Our second thesis point is that e.l.f. still has plenty of white space to expand at both existing and new retailers. So to understand the growth algorithm for existing retail partners, we spoke to retail buyers, and we came out of those conversations with confidence that e.l.f. still has plenty of runway to expand. So what we learned is that shelf space expansion is driven by sales productivity. And to illustrate what that means, at Target, e.l.f. is the #1 cosmetics brand in terms of sales per linear foot. So that's resulted in buyers at Target allocating more shelf space to e.l.f., with the brand growing from 12 feet to 18 feet on average per linear store recently. And we think e.l.f. will continue to grow further to 12 feet to match the amount of space that the leading beauty brands have. So the chart on the bottom shows that existing retail partners, Target, Walmart, and Ulta, will still contribute meaningfully to e.l.f.'s future growth. In terms of new partnerships, e.l.f. also recently announced a partnership with Dollar General, which is consistent with e.l.f.'s value proposition of making its products accessible to everyone. So Dollar General has over 20,000 stores in the US and would put e.l.f. within 5 miles of 75% of all Americans at full scale. We think this is a really significant opportunity, and to quantify what this could mean in terms of financials, we ran some back-of-the-envelope math to estimate that Dollar General could add around $160 million in incremental sales for e.l.f. In fiscal 29, and in addition to that, this would represent 40% of e.l.f.'s total year-over-year sales growth that year.
So our final thesis point is that near-term margins are going to remain more resilient than investors are believing right now. And longer term, the margin expansion potential is still intact. So starting with 2026, the stock is pricing in a 700 basis point margin contraction due to tariffs. But looking at how management was able to not just maintain, but expand margins last time tariffs impacted the business, and the fact that e.l.f. has a lot of space to increase pricing and significant bargaining power with their suppliers, we believe that margin contraction will only be around 150 basis points. And looking past all of the tariff noise, we believe that operating margins will hit 20% versus 13% today, and by 2027, margins will beat consensus estimates by 200 basis points. The e.l.f. business model is different from that of its peers because it has fully outsourced R&D and has shut down all of its brick and mortar retail locations, and these two factors combined add around 4 percentage points to scaled operating margins. So looking at the margin expansion in the past 4 years of around 250 on average, and 250 basis points on average, moderating operating leverage, and their 18 to 20% incremental margins, we believe that 2027 operating margins will hit 18% versus consensus below 16.
In terms of risks, bears are saying that e.l.f. will be challenged due to the China trade war, growth deceleration, and then also competition from both legacy incumbents as well as new entrants into the market. We think we have some pretty compelling counterarguments for all of these risks and are happy to expand on them in Q&A. Turning to valuation, we used a 12 times NTM EV to EBITDA multiple on fiscal year 29 adjusted EBITDA to arrive at our base case price target of $108 per share, which represents 96% upside and 26% IRR. On the multiple, e.l.f. trades at around 11 times, and we think a turn of multiple expansion is fair for a business with e.l.f.'s growth potential. Compared to the broader consumer discretionary sector, which trades at around 13 times, e.l.f. has historically traded above the sector in this post-COVID era, given its superior growth profile. To walk you through some of the drivers for our operating model, we assumed improved sales productivity leading to shelf space expansion, as well as successful rollout in Dollar General stores. And this translates to around 15% top-line CAGR, 20% operating margin, and then also 13% EPS CAGR through fiscal 29. In our bear case, in case some of these risks do materialize, we have 45% downside, but this still translates to a roughly 2-to-1 reward to risk ratio when weighed against our base case. In summary, we believe e.l.f. presents a compelling opportunity to own an innovative and durable beauty franchise with multiple growth levers, margin resilience, and asymmetric return profile. Thank you very much, and we look forward to your questions.
I could ask one about what are the demographics of the customer, sort of question one, and what were your thoughts on that customer current economic environment? And then, Dollar General, I don't think of as a great place to exhibit a brand. I think of it as the ultimate sort of wholesale type cheap channel. It seems inconsistent with like quality brand image. So I'm curious as to why that's a fit for the strategy for the company, and what the risk might be if it impairs the brand.
Yeah, sure thing. So I can start the demographics. So their target consumers are predominantly Gen Z and Gen Alpha females. They are gaining share with millennials and Gen Xers as well, actually. In terms of the Dollar General brand dilution.
What income level?
Yeah.
I don't think we looked into that, to be honest, but we will, and we can get back to you. I'm assuming not the super high income earners. They'll probably go for prestige, but even mid to lower income is what I would expect.
Is this a customer that shops at Dollar? I mean, people who shop at Dollar General. What are the demographics of people who shop at Dollar General?
Yeah, so I would agree with you. It tends to probably be lower income individuals who shop there. But what
These are people who shop at Dollar General are generally people who don't have enough money to go to Walmart because of the incremental gas bill. So it just seems like a strange channel, a very different channel than Target, for example.
What I would say to that is that, so if you look at e.l.f.'s pricing versus even mass competitors, it's the lowest of all the big brands. So it is supposed to cater to a wide range of consumers. And the whole point is it's for every eye, lip, face, and skin, is what they say. So, a little bit higher income earners will enjoy it because of the higher price and because they're really good use of their prestige counterparts. But also the lower income earners who also will wear makeup can buy it and still feel good about what the makeup that they're buying. So they can access it at Dollar General, whereas others might go to Target, but they're accessible everywhere.
Yeah, it goes back to what we showcased on slide 3, that accessibility is a pillar for them of the brand, and their average selling price is $650, which is well below their mass competition at $950. And seeing on our store visits to CVS, seeing younger customers interact with the brand and introduce their mothers oftentimes to the brand, they are really excited about the price point. It's very, compelling, and it's easier for a parent to say yes to their daughter that wants a small indulgence like this.
How do you said that the quality is high.
Mm-hmm.
How do you assess that? How does the customer know that?
So the way that we assessed it is looking at their like Amazon reviews. Like one big way that we assessed it is the Amazon reviews versus their prestige dupes, or like what people say they copied. And if you look at them, we look at the like ratings, they're either higher or at par. And then you look at the price. So like if you look at the quality to price, it's always significantly higher than their like prestige counterparts. So that's the main thing that we did. And mostly with the Holy Grails is where the reviews are really high. And those are the ones that are the main part of the business.
Thank you. Other questions? Manny?
All right, thank you for the presentation. My question is on historical revenue growth. I didn't see a slide, but if you could talk about what the historical revenue CAGR has looked like. I know the brand's been around for a while. I remember I bought Elf when I was in high school because it was really, really cheap. So that's my first question. And then if you could talk through what happened to the brand in 2023 and 2024. It grew 6% in fiscal 20, which is ending March. So I assume that doesn't really include COVID. So it went from, growing 6% to growing 48% in fiscal 23 and growing 77%, I guess, in fiscal 24, which is pretty amazing for an established brand. So maybe talk through, what happened there and why you think maintaining that type of revenue level, let alone growing off of that, is sustainable.
Yeah, so just in terms of the historical revenue growth, it's been at around 30% CAGR over the past 5 years. And as for why it's shot up or done so exceptionally well in recent years, I think there's three main things to call out. So the first thing is that kind of in the 2022 heading into 2023 timeframe, they released two of their most popular products. So that's done really well. And then the other thing that we looked at, which we thought was interesting, was in terms of marketing efficiency. 2022 is really when they hit their stride with their marketing strategy. This was the inflection point when the ROI on marketing turned positive.
That's TikTok marketing, right?
A lot of digital marketing, yes. Yes.
Sounds like they went like super viral on TikTok.
They've been successful. And then the last thing I would point out is that they've also capitalized on some kind of idiosyncratic issues with their competitors. So Estee struggled with China after COVID, and then Revlon declared bankruptcy in 2022. So Elf capitalized to gain share.
I'll add quickly, since we mentioned TikTok, it's not just TikTok. They also have a lot of other campaigns that went on. They did an ad at the Super Bowl that was pretty effective. They did like a short film before a Mean Girls movie. So it's not just TikTok virality, but that obviously helped.
Can you talk a little bit more about the Dollar General relationship in terms of the pressure that there may be on working capital, and what is the sensitivity to discounting? So, if there is a risk, whether, we go into recession or a deeper recession, think of sort of what that impact is, if you could run through the scenario analysis that you've done. Thank you.
Yeah, so maybe to take the second part of your question first, we think in a potential recession that Elf stands to be a beneficiary, a market share gainer in that sort of situation. We looked back at L'Oreal and Estee's experience in the great financial crisis, and Estee's revenue was down 8% year over year, 2008 to 2009. L'Oreal, when adjusting for currency fluctuations, they had a year-over-year growth of just negative 0.4%. So they were basically flat through 2008, 2009. And they're much more exposed. L'Oreal has much more exposure to mass and masstige, whereas Estee is mostly concentrated in prestige. So that would indicate to us that there was a lot of consumers that chose to trade down during that time. And Elf, obviously, based on the price points we mentioned earlier, they'd be a very compelling trade down candidate for many consumers.
And then just on the Dollar General point, so it's going to be a scaled rollout in Dollar General. It's not going to be all 20,000 plus stores from day one. So they can kind of take it incrementally to see how they're doing. So that, hopefully helps address part of the question as well.
They're also starting with a pretty, they're just end caps. So it's not as big of a rollout per store as well. Starting small.
Yeah, just following up on Manny's point, during the TikTok days and things of that nature, how has unit economics changed, or has it, what has been the trend? And in terms of the company's balance sheet, is this company financially independent? You mentioned a rollout. Do they have to go back to the market? I mean, could you talk a little about that? Thanks.
I guess I would start with so over time, the unit economics are getting better. They've been able to save on costs every year, so like the COGS per unit is coming down, and they have some increased prices. They've increased maybe 2 times, and they have a mix shift towards higher margin products as well in skincare. So the unit economics are getting better and better.
And in terms of the financial health of the company, which you asked about, their revolving credit facility is about equal to their cash outstanding. And then they have an $150 million term loan that comes due in 2027. And that's at a level that's less than 2 times EBIT for the company. So we feel very confident in their capital structure.
Are there anything in the covenants and the debt that would preclude shareholders getting most of the value created? Are there any covenants that they may break and things like that? Have you looked at some of the covenants?
They don't seem to be in danger of breaking any of their covenants. There's a 3% amortization on the term loan, so they have to repay about $5 million per year through that 2027 maturity. But they've been able to do that in prior years, and we believe will be continued to do so and to completely retire it in a few years' time.
Other questions? One question. You mentioned earlier that the subscription business, how big, how much of the revenue mix is that, and is there any like retention metrics around that?
So on the subscription business, so they don't break that out specifically. They do report an e-commerce number though, which should be here. So 16% as of their last fiscal year. I don't believe they report a retention number either, but the total membership has grown, I think, at over 20% year over year for the past 5 years, I believe it is.
And they have highlighted that the members on average buy more than the non-members that they've seen.
Okay, time's up. Thanks so much.
Good afternoon. Thank you guys all so much for being here. We're here to pitch Take-Two Interactive Software as Along with a $410 price target for 95% upside at 2.7 times risk reward. So what's the opportunity today and how will you make money? We believe that the normalized earnings power of Take-Two is much higher than the street thinks it is, with the post-unit monetization path of a GTA 6 buyer both clear and lucrative. Our view as to how Take-Two will achieve this is threefold. First, GTA 6 unit sales with 12 years of pent-up demand should surpass street estimates by 16% through 2029. Second, GTA 6 will catalyze an increase in recurrent customer spend in GTA Online with our estimates of average revenue per payer 42% above the street in 2029. And finally, the revamped monetization strategy should improve the retention in GTA Online of the GTA 6 buyer cohort, leading to durable earnings power.
Take-Two is one of the largest pure-play video game publishers with $5.3 billion in FY24 revenue. Its 3 largest franchises are Grand Theft Auto, NBA 2K, and Red Dead Redemption. Over the past 10 years, Grand Theft Auto has represented 38% of Take-Two's cumulative revenue, and the last game was released in 2013. In that time, the business has transformed into a recurring revenue business model, with 75% coming from recurrent consumer spending. Our first thesis point is that Take-Two is poised for a record-breaking launch with GTA 6 when it launches later this fall, with unit sales through 2029 16% higher than street expectations. So how do we decompose unit sales? On one hand, we have an install base on console, which is effectively our TAM, multiplied by an attach rate, which is the percentage of console users who buy the game. So, back on. So GTA 6 is launching into a smaller but more active install base. At launch, there will be 115 million units, and that will grow at a 7% annual CAGR. But this underestimates the willingness to play and the fact that GTA 6 is an incremental driver of console purchases. We ran a proprietary research survey with 895 respondents, and 20% said that they would buy a console specifically to play Grand Theft Auto 6. Now moving on to attach rates. We project a 34% attach rate, equating to 42.9 million units sold in the first year. So we looked at this and tried to frame this through two methodologies. The first was looking at the likely set of buyers from GTA 5's 210 million units sold over the course of its lifetime. We know that there's a very active cohort that continues to play GTA Online today. There are 44 million monthly active users, and we projected 66% would convert at launch. We then said, if 8% of the inactive or churned buyers came back, that would equate to 43 million units sold. And basically what we're saying is that 1 in 5 GTA 5 units will buy at launch. The second way we thought about this was through our survey work. And there were two key takeaways there. Number one, 98% of previous GTA buyers said that they would come back and buy GTA at some point in its lifetime, GTA 6 at some point in its lifetime, reinforcing the really special connection to this franchise. The second was that 34% of our survey respondents said that they had a console, a current generation console, that they would buy this product at launch, signaling high purchase intent. And finally, with regards to pricing, we assumed a $70 price point. And while we do believe there's upside on pricing here, we think that the crux of our thesis is getting the player into GTA Online and having them spend over the long term with recurrent consumer spending.
So our second thesis is that GTA 6 will be a catalyst for improving the GTA Online monetization. As you can see in the slide, it is severely under-monetized compared to its peers. But we think that there's a huge opportunity here to close this gap, especially with GTA 6 launch and also the shift towards a more structured monetization, incorporating modern gaming content. GTA Online was launched as an afterthought, just an extension of GTA 5, which is a 13-year-old outdated gaming platform. And it came out before the modern monetization methods such as battle passes or subscription services has become standard. As a result of this fact, it is monetized 2 to 6 times less than comparable gaming titles. Moving to the next slide, this is where we show that how GTA 6 could provide a value to the monetization structure. Street now assumes 5-point uplift in a payer rate from 30% today, and also the ARPU is going to reach high teens from current base of $8 through FY29. But we believe that the Street is underestimating the true potential. Based on the survey, expert interviews, we project 9-point uplift in a payer rate, and also the ARPU is going to reach high 20s by FY29. On the right side, it shows that there's a clear path to triple ARPU. Based on a survey work, we obtain a massive data for the player's purchase intent in each type of the game, gaming content, and we applied it to the variety of the modern monetization methods, and that math gets us a triple ARPU. And I would like to underscore here is that GTA 6 could be the catalyst for boosting the ARPU payer rate, and it's going to drive the commensurate increase and mix shift of the recurring consumer spend, and transforming Take-Two to a more recurring revenue-driven business model.
So moving to thesis point 3, GTA 6 units sold are the top of the funnel for GTA Online players. And we expect that GTA 6 should continue to benefit from strong unit sales in the years post-launch, similar to prior titles like Red Dead Redemption 2 and GTA 5. So what's the opportunity here? We think that the Street is underestimating the duration of the monetization opportunity for GTA Online's GTA 6 cohort. Playing this out in the numbers, the Street is estimating on average 70% annual retention of its cohort through our projection period. We think that this can converge closer to Fortnite's 75 to 80%, driven by modern monetization methods. In conversations with industry experts, including Fortnite employees, they highlighted the retentive benefits of some of these modern monetization methods. For example, UGC players and season pass players are 15 percentage points and 25 percentage points more retentive than players that do not purchase those items, which is a remarkable stat. Applying some of this uplift to GTA Online's cohorts bridges this gap and allows it and supports it converging with Fortnite's retention. Playing this out in the financials, it's a pretty stark contrast. This improvement in retention on just the GTA 6 launch cohort alone results in $600 million of additional revenue, and at a 40% incremental margin, $240 million of additional operating profit. To summarize, improving the retention will be a key driver in increasing the duration of the recurring revenue base, which will support the durable earnings power for GTA.
So in valuation, we expect the 3-year target price of £410 based on 24 times PE in FY29 EPS, with a 4-year revenue CAGR of 90%, and this results in a 23% IRR. And comparing this for our risk case price, it still yield an attractive skew of 2.7. Moving so what I would like to mention here is that even excluding any impact of GTA 6, we believe that this takeout valuation of this business is still substantially in excess of our risk case price, effectively knocking out our downside scenario. And I would love to add more detail about this context in the Q&A if it's of interest.
Quickly touching on some of the risk and mitigants, the risks here are relatively straightforward. GTA 6 could underperform either commercially or critically. GTA Online could fail to take advantage of its monetization opportunities. We get comfort from the fact that GTA has a rabid fan base with 12 plus years of pent-up demand, and that from a critical standpoint, Take-Two is famous for its maniacal focus on the quality of the titles that it releases. And as an interesting data point, 3 of the top 10 highest rated games of all time are past GTA titles. In conclusion, we believe that the street is underestimating the normalized earnings power and the long tail of monetization opportunity here. And we'll wrap up our presentation and turn it over for Q&A. Thank you so much for your time.
It's always a little bit challenging to value these hit-driven businesses. But one question for you is, looking at GTA 5, what is the at the end of the cycle now or last year? What was what the organic revenue was of just that business?
Yeah.
The organic revenue growth.
Yeah. So they continue to sell about 5 million units per quarter of GTA 5. In cumulative, they've sold about 210 million units.
What's like a percentage revenue growth?
So I don't know the growth number off the top of my head, but it represents 38% of the past 10 years of revenue for Take-Two as a whole.
Well, 5 million units, did they sell fewer? They sell 5 million flat a year and they raise price, or what do they do?
They've been selling about 5 million units, so the price has been somewhat constant now. So the way that the games work is at release, the price is what it is, and then it's discounted over time. And so they've been selling consistently about 5-ish million units per quarter.
So I think the answer to your question is there isn't growth.
Yeah,
that's the, because they have other franchises and they release other franchises. So when you put a 24 time multiple on your 29, I guess, earnings estimate, what do you think is the growth rate of the business?
So for the multiple standpoint, we think this is a conservative number. This is because we have 2 reasons for this. First is that we expect Take-Two to fundamentally change their business model from like a unit sales hit risk to a more recurring revenue drive business model. And the second reason is that the historical multiple support this. First is that 10-year median of this multiple is 25.5 times earnings, but it reflects some period without any expectation of GTA 6, and also the market is currently traded at 20 times earnings, and historically Take-Two has traded at 7-turn premium to the market, so we think that 24 multiple is conservative and warranted.
But I guess my question is, once you're at that end of the cycle, right, and what do you forecast to be the growth rate of the business then?
Yeah, so we expect the revenue growth is going to be 90% CAGR growth. The revenue CAGR is going to be 90%, but also the total revenue, 80% of the total revenue is going to come from the recurring consumer spend, which means that the source of the revenue is going to be fundamentally changed. And so that is one.
And the last thing that we'd say on that is, to your point, yes, revenue will decelerate in the outer years as GTA 6 catalyst starts playing out. However, there's always GTA 7, and there's a very deep pipeline of other games that we have in an appendix slide here that we think that they should be able to continue to drive attractive revenue growth going forward.
Actually, if you go back one slide, I think Ali can answer your question. right? So there's a big step change from, call it 2025 to 2026. And then the growth is fairly minimal on the revenue line item, I guess because there's no expected new entrants for a while.
Yeah, so
Sort of an unusual business where you have this explosive growth from the launch of a new product. And then it depends on, so if I could just ask a question, a lot of this, what you talked about here and your estimates are based on a survey, right? Or one or more surveys. Can you describe how you did the survey? And what were the demographics? How did you pick the people who responded? Were they compensated? Give us all the detail on that.
I'm glad you asked. So they were not compensated. We wanted to try to target the two different customer profiles that we thought would be a GTA buyer. First, we did a survey of our peers. We distributed it through Columbia, through other business schools, family, friends, siblings, and friend groups to try to build a mosaic of what an average GTA buyer might look like.
Do you think your Columbia classmates represent an average?
They may not, which gets us to our second point, which is that we also wanted to try to capture the kind of the rabid fan base, this 5% of users that account for 80% of the spend. And that really informed a lot of our monetization metrics. And so for that, we went to Reddit and to the internet, where else? And through that, we were able to really build a customer profile, which turned out to be about 91% male. It is a little bit older than if you think about similar games like a Roblox, where 60% of the users might be under the age of 16. In this case, 50% of the users or players were over 24, so they have hopefully jobs and stable incomes and higher purchasing power than maybe a Roblox or similar game. And importantly, there was no structural difference in the ability to spend or the interest level. It's really just been that Take-Two has not had the opportunity, has not provided the opportunity for these players to increase their spend.
Yes, so
So I have two questions. The first question is, this is supposed to be launched at the end of this year, correct? So what are the risks? Can you talk about management's ability to execute on their launch date and the risks associated with any potential delay? And then the second is, I believe that this is going to be launched on consoles versus PCs, right? So the PC will come after. So what's the mix between those two? And is that potentially damaging to the PC player that they have to wait? Thank you.
Great. So addressing the PC question first. So that's correct. PC, it's launching first on Gen 9 consoles. The expectation is that it will launch on PC a year later, and that's what we're reflecting in our assumptions. PC gamers have increasingly become a larger component of overall gamers as a whole. And in terms of magnitude and mix, we see PC units sold reaching about 33% of cumulative units sold by 2029. This, we think there could be some additional upside there, and on other people we've talked to, that mix is a little bit higher, but we wanted to be kind of conservative in that assumption. Your first question was?
Yeah, also for the management execution, they have changed their comms plan for the management. They have started benchmarking the recurring consumer spending. So this implies that the management, the main focus is going to be the recurring revenue base rather than the unit sales. So.
And to your question on the delay, so we think about this in a few different ways. One, in theory, if they were just to push back the delay and the users and all of these things by a quarter or two, the impact on our return would be de minimis. Would the market react that way? I don't think so. For example, just earlier this year in their earnings call, they announced they reconfirmed a fall release date, and the stock on an otherwise unnotable earnings print went up 14%. If they were to announce some sort of delay, the market might fear that there's a quality issue with the game. It may not be ready. We feel very comfortable with this, given Strauss and the rest of the team's maniacal focus on quality, quality, quality. This is a developer-led studio, and they're going to put out the best game possible. They know the future of their company rests on the performance of this, and I think they're going to really want to nail it.
Anthony. So we should just leave these on.
Yeah, we should.
Conserving batteries for Columbia.
So the margins on this business are interesting, right? Because they were like in the mid-20s and then they came down to like 13%, I guess, last year, presumably because they're investing in GTA 6's launch. But then I think in your out year, they go up to 37% and you're exiting off of that. Is that really the right way to think about it? Shouldn't you kind of like, that's kind of a peak margin, right? Aren't they going to have to invest again at some point? It's a little bit like retail chain that has to remodel their stores every 10 years, where like you don't want to exclude that because like presumably there's going to be some like average investment that you need over time. It's lumpy, right? Maybe it only happens every 5 years, but shouldn't that be kind of a fraction of that be in your exit earnings base to account for the fact that they're going to have to work on GTA 7 eventually, right?
I think that's a really good point. So importantly, much of our margin expansion and how you think about this is they've begun investing a very large sum of money in sales and marketing to promote this upcoming game. We think that they'll continue to do that as the game launches and they realize hopefully some of the success of it. We think that, to your point, yes, there's always a next game. There's always development costs that are going to have to go into that. But much of where we see this margin expansion is really a return to normalized historical sales and marketing spend as a percentage of revenue in the outer years, once they've kind of burned through this GTA release. Importantly, if you look at comparables like EA, their margins currently right now, their EBITDA margins are in the 35% range. And so we think that there's not many major structural differences that should impede those two things converging.
Just a follow-up to Ali's question, and I'm sort of struggling with this in terms of how to value this business. You're sort of picking a multiple in an out year, right? You know, it's kind of a very unusual business that's very chunky, right? And you know, it could be another decade before GT7, for example, right? So you picking a particular year and using that year's earnings to put a multiple on it, seems to be, I'd rather value this business like on a DCF basis and make some projections about, you know, number of titles being launched in the future. I mean, have you done a model that way? You know, maybe like kind of a longer term kind of DCF, or is this basically your approach?
I'll opine quickly on it, and then I can turn it over to. So, definitely agree with you. This historically has been a very lumpy business. We think it will be a lumpy business in the interim as well. What is difficult about that is then you're forced into making projections and assumptions about GTA 7, 8, and the cadence at which that launches, and because that will have a material impact and then the future earnings power of the business. We think importantly that this is really, the story here is this is a transition from what has historically been a hit-driven studio launch thesis to this recurring monetization note.
What percentage of the revenue will be recurring monetization stuff?
So we've got right under the total revenue, recurring revenue we think is going to mix up to a 78% and off of a higher quality of recurring revenue because it will not be tied to as much of the mobile.
And also in FY29, we project the in-game project of GTA Online could reach more than $3 billion. And when you look at Roblox, their value at 7.6 times over next term recurring revenue. So it implies that it can support the enterprise value of the total GTC.
Okay, so the recurring revenue part of the business today is what percentage of revenue?
So at launch, it'll be about 58, 57% of the business.
What is it like now?
Today, it's around 70%, which we have.
It's gonna shoot up when they release the game.
Yeah.
Yes.
Yeah.
It just goes down and then.
Goes down, and then it'll come back up.
Yeah, it first goes down. Okay. Interesting. Other, 1 minute, question.
Real quick, going back to the lumpiness of the business, help me understand, the recurring revenue stream is people buying the
Add-ons on the game?
Is it the microtransactions or is it the buying the game over and over year over year? Because you know those microtransactions I see on my credit card from my kids.
We had a great conversation with someone who described Roblox as a digital babysitter. And we think that actually a lot of this is transitioning to those microtransactions. And while there is a potential to double dip when the PC launches historically a year after the console, there also, we didn't include in our projections, but so much of the street believes that PS6 and the next version of the Xbox will launch in the calendar year 27, 28. So there may be a double dip opportunity, but a primary point of this thesis is that this is transitioning to a recurring spending model, and we have multiple ways to monetize sideline buyers who have not come and played a season pass like a Fortnite or Roblox might have.
So our thesis is that you unfortunately might be seeing larger numbers of microtransactions on your credit card bill.
Is it for like a Roblox and this company, is it traditionally like gaming, you have like the WoW customers driving a lot of their revenue? Is that similar in this case? Like 2-3% of the users actually drive most of the purchases?
So roughly around 5% drive 80% of the microtransaction spend today. I think SK has some great points on for the microtransactions.
It's like the spirits of the alcoholics, right? There's a huge amount of it.
And the payer rate is in that. So for Fortnite, EAFC is a little bit higher in the low 40s, and Call of Duty and GTA Online, the percentage of monthly active users that are payers is in that 30 to 40% range, whereas Roblox is closer to 1%.
And so 25% of the GTA player have played more than 2,000 hours.
Of a self-selecting Reddit survey that we saw online, but of 2,300 respondents.
So when you think about it,
When does the game come out?
Fall of 2025 is.
My brother-in-law is working on the game. Yeah, true story.
Should have added him to
I'll
our.
tell you what he thinks. All right, thank you so much.
I'll pass it through.
Okay. Hi, everyone. I'm Max. I'm here with Farouk and Evan, and we're pitching WEX. We recommend buying the stock and have a $220 target price, which is about twice the current share price. However, we think if management were to take the right strategic actions, shares could triple or even quadruple. So WEX is a $4.5 billion market cap and $8 billion enterprise value company that operates in niche areas within B2B payments. We think it's generally misunderstood by investors, and it doesn't help that Bloomberg has its capital structure completely wrong. So WEX has three segments: Fleet, which is about 55% of EBIT, Benefits, and Corporate Payments. Within Fleet, WEX issues fuel cards, provides software and analytics to fleets. And you might ask, does this business need to exist? The answer is yes. WEX solves a number of pain points that fleet operators have. In Benefits, WEX provides software for the management of health savings accounts. And in Corporate Payments, WEX issues virtual cards, which are primarily used for B2B transactions from online travel agencies to hotels. So here we break down how WEX makes money, but there are really two takeaways we want to highlight on this slide. The first is that in Fleet, 2/3 of revenue comes from interchange. And WEX operates a closed-loop payments network like American Express, so it actually sets this rate. The remaining 1/3 of revenue comes from fees that are either subscription or late fees, and these are essentially pure margin. The second point is that Benefits and Corporate Payments are completely separate businesses that have absolutely nothing to do with fuel. So today, WEX is trading at a 60% discount to its historical P/E multiple of 20 times, and the obvious question is, why does this opportunity exist? And we think there are three reasons. One, we think the market still primarily views WEX as a fuel company, even though almost half of its earnings don't come from fuel. And furthermore, we believe that WEX actually has pricing power to more than offset the declines in fuel prices that the market is concerned about. Second, people are very concerned about the shift to EV. Our proprietary research indicates that not only is this not happening as quickly as people think, but even if it were to happen, WEX stands to make more money, not less. And finally, there's no nice way of saying it, the market has lost confidence in the management team. Over the past 10 years, the stock price has been flat while revenue has tripled. And we're not the only ones who've noticed this. Activist investor Impactive has been involved in the stock since 2021. And very interestingly, this year, for the first time, management's comp is now directly tied to stock performance. We think that management is now laser focused on the share price and returning capital to shareholders. but it's actually already happening. Recently, they conducted a tender offer and repurchased 12.5% of the company. I'll hand it over to Farouk to talk about our thesis in more detail.
Thanks, Max. So I'm going to talk about how are you going to make money in the stock, which is, I guess, why we're all here today.
Certainly why the judge.
Well, so the majority of it is driven by earnings growth, and there are two drivers within that: fleets and benefits. Fleet is the bigger driver, so let's discuss that business first. So essentially, fleet is a duopoly between WEX and Corpay. Historically, used to be called FleetCor. WEX has been taking share from FleetCor over the past decade, and right now it commands about 1/3 of the market. One interesting thing is, if you look at the slide on the chart on the right, FleetCor is essentially priced 50% higher than WEX, and the obvious question is, why aren't the fleets switching? And the answer to that is, especially for a large fleet operator, it's very hard to do. So is WEX going to do anything about that pricing differential? Well, actually, yes, and the management has started talking about raising prices. So if WEX were to increase prices by 30%, they'd get back to high single-digit growth rates. And as we mentioned, remember, the stock sold off really on that declining revenue growth. And so we believe that the market doesn't believe that it can return back to that high single-digit growth rate. But one important piece to mention here is, if you look at this chart right here, we're assuming a 30% increase in pricing, and even with that, WEX would still be priced lower compared to FleetCor. Now you might say, is 30% price hike realistic? Well, actually, yes. So if you look at the past commodity crisis, when fuel prices went down, WEX has actually raised prices by 30%. And the beauty of it is that once the fuel market rebounds, the subscription piece stays the same, and so you get double the benefit. Now, let's address the elephant in the room, and that's the EV. So to get comfortable around this question, we've surveyed about 15,000 fleet operators, gathered over 100 responses, spoken to a dozen fleet managers, and really the feedback we got from them is quite different from how the market perceives the situation. First, EV penetration, as you can see on the left chart, EV penetration in commercial fleet is incredibly low today. And the majority of fleets that we've surveyed are not even thinking about going electric in the next 5 years. Second, even if we were to go full EV, WEX's pricing would be 50 to 70% higher today, because the answer to that, why? Well, it's just a lot harder to manage a fleet of EVs. Essentially, imagine you have a driver taking the car home, charging, in the garage. Now you got to figure out how to reimburse, and so there's a lot of that goes into it. We, happy to discuss that during Q&A. So, with fleet out of the way, let's talk about the second piece, which is the benefits, and that's really a hidden sort of crown jewel asset for WEX, which grows at a 20% CAGR, but this growth has been masked by the other two segments. So, as many of you might know, HSA is a secularly growing category, but we're not really underwriting any of that growth here. What we're essentially assuming is HSA, health savings accounts. Yeah, so in this segment, if you look at the chart on the left, here again, you could see that WEX is priced significantly lower compared to its direct comp, Health Equity. And but we're not assuming any of that sort of price increase, drastic price increases. All we're assuming is that subscription fees grow in line with inflation, and the portfolio, the float business reprices over the next couple of years, and then you get the.
Just explain what this business is. I don't think we understand what the business is.
HSA?
What their business is.
they're essentially managing HSA assets for employers. So, you have your employees, you would outsource that to WEX. They'd charge you on a per seat basis. And, that takes a lot of the headache off of you.
It's an asset management business?
It's not an asset. So they make money two ways, 60% in subscription and 30% they essentially earn money on the float because a lot of the assets sit in the deposits. So they would invest those deposits in MBS, corporate bonds, and earn interest on it. And that's essentially how the business. There is the interchange component in a sense. You have the card, you go to a doctor, you spend the money. They would charge interchange on that, but that's a minor piece within that business. So with that, putting it all together, as you can see, it's a fairly complicated business, which we think the market is totally missing how to value. So with relatively conservative assumptions, we get to roughly $900 million of earnings, which is 35% above consensus. And with that, I'll pass it over to Evan.
Thank you, Farouk. And for the final part of the presentation, I'd like to discuss valuation and capital. Oh, I'm sorry. I'd like to discuss capital allocation and valuation. So for something very interesting has happened in this business. So historically, management has been incentivized to hit revenue and EPS targets. And so for the first time in a long time, they're actually incentivized to focus on relative stock performance, relative and absolute stock performance. The stock has basically been flat for the past decade, whereas revenue has tripled over that time. So it hasn't really worked out well for shareholders. So WEX trades at a 60% discount and trades at a 60% discount to historical multiple. As you can see, top line revenue has slowed down, has declined, and we believe it will return to high single digits over the next 2 to 3 years as the moat retains intact. We think putting it all together between management incentives and low valuations, we think there will be a change in capital allocation strategy. Management has repurchased 12.5% of shares in March 2025. And for the valuation, we think it's a double in the base case scenario, assuming no multiple expansion. And we think there's actually a massive value unlock scenario here with the benefits business with 3 to 4x upside potentially if management were to spin off or sell this business. And even at a 25 to 30% discount to their direct comp, which is health equity. So we think we're basically getting fleet and court payments for free if you buy WEX. And then finally, I'd like to discuss risks. And obviously, tariffs are top of mind for everybody right now, given the current situation. We think they're mostly insulated from the primary effects of tariffs, given that 90% of the revenues come from within the U.S., and we've underwritten lower travel volumes and lower fuel prices. Thank you for coming to our presentation today, and happy to take Q&A now. Thank you.
Great, so I still don't understand the business, okay? So health equity account is basically, people can take a portion of their earnings, their employer puts it into like an account. The investor's entitled to just a deposit-like return, is that right?
They essentially earn nothing on the deposit.
Nothing.
Yeah.
Okay, and the company has total flexibility in how they invest that money, or how does that work?
Yeah. So essentially, they custody 80% of the assets through WEX Bank. So to add complexity to the whole story, there's actually a WEX Bank.
The customer gets no interest income on the money?
On the deposits, yes. Unless they invested in investments, in which case they would then earn, whatever returns that they get from the investments.
Most people, what do people do?
So you could see on the chart here, so 65% is in deposits, so essentially, free funding. 35 is investments. Now, historically, with the rate hikes, that balance has started shifting because, like a couple years ago, 80% of it was in deposits, but the shift is not happening that quick because for a lot of the accounts, there's like a minimum, like you have to keep like a $2,000 balance in your deposits before you can actually allocate any money to the investments, and so.
And how do the investments work? Does the individual get the return they earn on the investment?
Yeah.
Does WEX charge a fee on that or no?
No. So for a lot of the investments, they're actually, those assets sit at the partner banks. So WEX doesn't really custody those assets. And so whatever they earn on those investments that.
And you put like a 15 multiple on the earnings from this business?
Well, Health Equity, which is a direct comp, right, trades at a 25% EBITDA, EBIT, because.
5 times EBIT multiple?
Yeah.
Okay, and so what are the revenue streams for this business? You got float, the spread that you're earning on deposits, and you said some kind of subscription revenue? I don't need a slide. Tell me about the
Okay, so are you interested in HSA or?
HSA. How does it work? I'm a company and I choose WEX.
All right, so you got a bunch of employees. They need HSA accounts, so you'd go to WEX, partner with them. They would charge you subscription per seat, so that's 60% of the revenue. The rest they earn on the float.
And who else is in this? I mean, does Fidelity?
Fidelity is more of a direct to consumer. So these guys go through the corporates. So they go through large corporates. Fidelity is direct to consumer. United Health, Optum Bank, they're in that as well. But that's more captive to the United Health business.
And then the fuel purchasing card business they get a scrape on every fuel purchase, or how does it work?
Yeah, they get a rebate on fuel prices, but then that's actually not the most important piece. I think the most important piece within that, imagine you're a CFO at the trucking company. You want to track item by item what the expenses are, because that goes into your total cost of ownership calculations.
So it's a credit card.
It's a credit card essentially, yeah, because
You get itemization on the.
Itemization,
how much is fuel, how much is food, how much is this and that.
And you can limit what the drivers can spend on, and that's like very important to mention. That's why it's important that it's a closed loop, because with like Visa, MasterCard, they don't get that granularity in terms of the transactions, and so as a fleet operator, you can really limit what your drivers are purchasing. So if you don't want the guys buying a pack of cigarettes, with that card, you could do that. So that's essentially.
Very helpful. Okay. Yes.
On the benefits side, are the customers the drivers of these trucking companies? Is that who they are, or is it much more diversified?
There's very little overlap.
I'm sorry. Very little.
Yeah.
Okay, there's the fuel card, benefits, and wasn't our third business, or
corporate payments?
And what's that business? How does that work?
Yeah, so essentially what they do there is it's about 60% of the business is tied to online travel agencies. So if you book a hotel on booking.com, where they're involved is when Booking actually pays the hotel, they essentially issue a one-time card for that transaction. So that's their service to Booking.
Okay, don't understand that one either.
It's a
virtual card.
It's a virtual card. Yeah.
Why does it need to exist?
I think one of the main issues is fraud prevention. I think that's something that we saw come up in some of the expert call transcripts we reviewed, is that this is a business that's very susceptible to fraud. You could potentially set up like a fake hotel or something and try and make money off that. So each card is just a one-time card for that transaction, and then it can't be used in the future.
Okay, Julian.
We went after fleet call, or fee call, we used to call it, because there's a lot of nefarious behavior in this business. So while it's supposed to mitigate fraud, the fraud is perpetuated by the companies, because in the case of Corpay, they were overcharging and gouging their customers, so it ended up with the DOJ. So I've sort of pushed back on this notion that you can increase prices, because I believe that the bulk of the people or the companies using it are sort of small, medium businesses, right? So the average is, in the case of Corpay, it was like $70,000. So they actually came together in a class action lawsuit to sue Corpay which ended up the DOJ. So I think that the premise or the thesis behind being able to raise pricing is really challenged for this business. So how much of your thesis is predicated on that from actually happening?
Alternatively, you can tell her why she's wrong.
Yeah, with all due respect. So one piece, so if you look at the chart on the right, actually, Corpay, they're a little sneaky, right? That whole FTC case, and they're actually reporting numbers on a net basis. And so that slide, we're really not comparing apples to apples, because for WEX, we're taking that revenue per fuel transaction that they earn, and that's a gross number. For FleetCor, that's a net number, and you get a 50% price difference. So if you actually look at the gross basis, which again, we can only estimate, the differential would probably be twice as high as what WEX charges. So that's one. The second pushback on that, well, they actually did raise prices. So when in 2015, 2016, when fuel prices went down, they increased the subscription piece, which, as you could see, so they lost about $60 million on just lower fuel prices, but that more or less with $50 million, offset from the subscription piece. And we've actually put together throughout different cycles, which you could see here how the pricing has changed. So that at the very bottom, the delta to WEX. So that's really how the pricing changes, and you could see. So the way it moves is, Corpay would raise prices, and then a couple of years later, that delta would widen between, their pricing, and then WEX would then raise prices. And so we're really making a statement that, we're not even assuming anything, out of extraordinary, because we're assuming they raise prices so that there's a 22% difference between them. And historically, there's been plenty of times where they've gotten even as low as, 10%. So.
And just sorry, to Bill's prior point, why does this business need to exist, right? So there's a lot of innovation, things like RFID, where you can marry the tank to the petrol station. So why does that actually need to exist at all?
Yeah, I guess I can start, and feel free to jump in, guys. But I think one of the main things is that in our survey that we conducted, fleet operators just care that this product works. And when you look at the kind of total cost of ownership that we modeled out here, this is almost a de minimis percentage of the TCO. So if you're a fleet operator and you're trying to be more cost efficient, your fuel card is really just not what you're focused on. We've also reviewed trucker forums, and again, there's not a lot of focus placed on which card to use, because it's really just one of your smallest expenses. So it sort of works, and it's just not the area that they're trying to immediately change if they're kind of pressed on costs.
We're actually out of time, but I'll let you finish with one last comment.
Yeah, I would add to that is, as a trucking company, your biggest expense items are fuel and driver costs. And so if you run maybe 2 trucks, maybe you don't need WEX and you can easily switch between providers. But if you're running a fleet of 20, 30, 50 trucks, for that less than 0.5% of the total cost, it's just not worth the headache to kind of go and rip out the software piece out of it. So that's essentially why the business exists.
Thank you. Thanks so much.